Hi, I'm Linda Eedes, and this is an update on the RECM Equity Fund, looking at the first quarter of this year, talking about some of the contributors and detractors to returns during the quarter, and then finishing off with an overall summary of how the fund is positioned currently. So looking at the first quarter of this year, it was obviously a very negative one for South African equities in general. If you look at the JSE All Share Index, it was down 6% for the first quarter of this year. And the fund was actually just slightly negative, negative 0.8% after fees. The main reason why this fund held its ground very well relative to the market is because we don't hold any NASPAS in the portfolio. Obviously, NASPAS has come off quite a bit. Since its peak in late November, it's come off more than 20%, and that would have had quite a significant impact not only on the index, but of course any portfolio which is benchmark oriented, which sort of is positioned closer to the benchmark or the market than we of course are. And during the first quarter of this year, in fact, a lot of the sort of local South Africa incorporated type stocks, the sort of industrial type businesses, the nuts and bolts type businesses, actually had a very strong quarter. So that sort of helped to bolster the portfolio during quite a difficult time for most equity funds. And we expect that to continue. RECM is known for holding its ground when markets come under quite a bit of pressure. That is because we tend to move away from the market and away from those parts of the market which obviously do pose some risk of reversal, where they've had very, very strong gains and where the prices have run ahead of fundamental value. We've been positioned away from those parts of the market for quite some time, and we've got quite a strong orientation towards, as I say, those domestic businesses which have been out of favor for quite some time. But increasingly, with the rand being so strong, we're starting to introduce more and more exposure ever so slowly into those sort of more rand hedge kind of businesses. So the businesses which obviously with the rand being strong and with a few missteps on the parts of the companies have actually started to offer a bit of value. We spoke last quarter about Mediclinic, which is now in the portfolio, and we're starting to take a closer look at many of those businesses which were the flavor of the day when everybody expected the rand to continue to weaken. Another stock like this which has come into the portfolio is Reinet. Now you'll probably be aware of the fact that more than sort of half or roughly half of the exposure in Reinet is to British American tobacco. Tobacco was obviously a very defensive part of the market that most investors fled to when the global cycle was at its low point. Now with the global cycle seeming to sort of work its way through the system, all the cyclical businesses which are tied, for instance, to the commodity cycle, luxury goods, emerging markets, all of those sort of more cyclical type businesses are now starting to do very well. And those more defensive parts of the market are coming under quite a bit of pressure. And British American tobacco is actually off almost 50% from its highs, which is quite astounding if you think about how popular it was at one point in time. So you're starting to see those kind of opportunities come into the portfolio. We are fully invested in the local equity market. We see opportunity in the local equity market, and it's in those parts of the market which have been out of favor for quite some time, but are now starting to actually sort of be recognized for the value that they actually hold for investors.